Hello, this is Brant Spessart with Steward Wealth Strategies, and thank you for investing a few minutes with us as we talk about the benefits and the urgency of Roth conversions. So today we're going to talk about what a Roth is, strategies for Roth conversions, but also some key takeaways, and I'm going to elaborate and say next steps, things you should actually consider doing after you watch today's webinar. So the Roth IRA was originally conceived back in the late 80s, but really kind of put into place late 90s, around 1997 and 1998. It was the brainchild of Senator Roth. And the Roth over the years has evolved, but it has also had some rules that have changed. In 2010, there was a limit on what your income could be in order to be able to convert money to a Roth. Well, that was lifted, and that was part of the Tax Relief Act. And then in 2013, with the Affordable Care Act, income tax rates increased. The Tax Cut and Jobs Act went into effect in 2018. In 2020, there was a Secure Act. And then in 2025, where are we going? There's going to be mega required minimum distributions. The backdoor Roth could face repeal. Could be a conversion phase out as far as being able to take money from IRA to Roth. There could be some adjustments there. The one thing that we know is constant is that there's going to be change. But what we have to remember is what is a Roth and why? Remember, the difference between a traditional IRA and a Roth IRA is that the Roth is funded with after-tax money that's already been taxed, but as that money grows, it will potentially be tax-free growth and tax-free withdrawals down the road. But we have to keep that in mind because, according to Bob Keebler, one of the top CPAs in the country, taxes are the biggest drag on investment performance. It's great to have great investment returns, but a lot of times we may give up some of those results in the form of taxation. So what is a Roth conversion? A Roth conversion is where you take money that is in a pre-tax or traditional IRA and you move it, you do a transfer essentially into an after-tax Roth IRA. That movement of money from one retirement account to another, from a traditional pre-tax IRA to a after-tax Roth IRA, that is considered a conversion. It's direct from one account to the other. When you do that, though, when you take money from a pre-tax account and you move it to an after-tax account, that amount that you convert is actually declared or claimed as income in that particular calendar year. And I want to stress calendar year because sometimes, with contributions out of pocket to a Roth, that generally has a deadline of April 15th the following year. Roth conversions have a deadline based on the calendar year, based on December 31. Very important to remember that. So why do a Roth conversion? Well, here's the thing. For a lot of retired folks, you may be subject to required minimum distributions where you're being forced to pull money out of your traditional IRA or traditional 401k. Well, a great benefit to Roth IRAs, if you use a conversion to fund them or even regular contributions, one, they're not subject to RMDs. They're not subject to required minimum distributions. That can help lower somebody's taxable income during their retirement years. Roths are also, they grow tax-free. They compound tax-free. So over time, as you grow this bucket of money and it's growing tax-free, you're reducing or maybe eliminating required minimum distributions. You are overall lowering your taxable income. And also, beyond our lifetime, Roths are a great way to transfer wealth because the withdrawals for our beneficiaries can be tax-free as well. So when you convert money from a traditional IRA to a Roth, it does count as taxable income. The converted amount is added to the top of your income for the year. So it is very important to understand what tax bracket you're in and what tax bracket you will be in, because that converted amount is going to be taxed at the highest level. But here's the thing. If you're under the age of 59 and a half, many times people are concerned if they're under age 59 and a half, that if they pull money out of an IRA, they'll be subject to penalty. Well, a conversion is not technically considered a withdrawal in those terms, and a conversion is done without penalty. Now, the withdrawal sequence of a Roth IRA, if you ever have to withdraw money from a Roth IRA, or when you have to withdraw money from a Roth IRA, it is very important that you report your contributions every year to your tax professional. Your tax preparer needs to know if you contributed to your Roth. Conversions do generate a 1099 that will declare this as well. And it's very important to keep track of forms 5498 that generally go out around May or June each year. Because when you withdraw from a Roth, your basis is what's considered initial withdrawals. Then the taxable conversion, then non-taxable conversion, and then finally, what's left are your gains and your earnings. Now, that's for a Roth IRA. With a Roth 401k, if you have a 401k that has the Roth feature, when you withdraw from that, if you're possibly withdrawing early, just know it's pro rata. It's basis and gains. So if you leave an employer and you have an old 401k, it is a lot of times very strategic to consider rolling that 401k to an IRA. And especially if it has Roth dollars inside of it, rolling those dollars to a Roth IRA. If you have an old 401k, whether it's pre-tax traditional or a combination of Roth, please reach out to us. Let us know. We can help you facilitate that rollover for that 401k plan. Now, when you withdraw from a Roth, no, it's not always tax-free. Generally it is, but there are certain rules that have to be met. One, you have to be at least 59 and a half or older for the growth to be considered tax-free, and the Roth has to be established for at least 5 years. So the Roth has a 5-year clock. So consider making a contribution to a Roth as long as you qualify to start that 5-year window. Each of those conversions also have a 5-year window as well, or 5-year clock as well. But remember, the two things to keep in mind with Roth is age 59 and a half and a 5-year clock. Now, when we think about the tax planning aspects of Roth, we're all in different tax brackets. Right now, I believe it's 7 different tax brackets for 2024. 2025 will have 7 as well. We have to think about, well, what bracket am I in today? And does it make sense to pay tax now in that IRA to convert to Roth so it's tax-free later on down the road? I would say almost always, if you're in the 0, 12, or 10 or 12% tax bracket, you should almost always do Roth conversions. Fill up those brackets right there. Take advantage of those low tax rates. If you're in the 22 to 24% tax brackets, marginal brackets, well, that takes a little bit of calculation. We really want to think, hey, does that make sense? What does it look like 5, 10, 15 years out for you to see if it really makes sense paying taxes today at that 22 and 24% rate? If you're in the higher brackets, the 32, the 35, or 37, look, you're very tax sensitive. You're at a high bracket right now. Does it make sense paying taxes at a high rate today to have it be tax-free down the road? I don't know. That's going to require some coordination with us and your tax preparer to see if it makes sense. Let us review your financial plan to see if that makes sense. So when you think about Roth conversions, there's really two frames that we want to look through. We want to look through the lens of tax bracket management, but then we also want to think about the strategic aspect that may be beyond ourselves. So tax bracket management really is, hey, is a lower income tax year for us? Is there a reason we should take advantage of that? Do we have low income because we changed jobs, we lost a job, you know, we lost money for whatever the reason might be? Are we in a lower income year than normal? Are we in some sort of favorable tax bracket based on whatever the situation might be? Do we expect larger itemized deductions this year? So should we fill up the tax bracket that we're in? Are we in that 0, that 10, that 12, maybe the 22, maybe the 24? Or are we thinking more from a lens of being strategic for others? Should we proactively convert based on who may receive the funds later on down the road? Remember, Roth growth is not just tax-free for you based on the qualifying circumstances, but it can also be tax-free for our heirs. It could be tax-free for our spouse. It could be tax-free for our children. It could be tax-free for our grandchildren. So think about the long-term aspects, the generational tax advantages to a Roth conversion as well. Wealth transfer rules changed with the Secure Act, where non-spousal beneficiaries are forced to pull money out over a 10-year period. Does it make sense to possibly convert if we're in a lower tax bracket than where our heirs may be, as they're having to withdraw that money out over a 10-year period? Please, if this is causing some concern or any sort of confusion, reach out to our office, talk to your wealth manager. Let us talk through your specific scenario to see if it makes sense for a Roth conversion. Now, the legacy implications. So is it the same for all our heirs? The answer is maybe, maybe not. You know, if we think about our non-spousal beneficiaries, you know, are all of our children in the same tax bracket? Do they all have the same financial circumstances? Do they all have the same income, the same roles? You know, all beneficiaries may be loved equally, but they may not necessarily be taxed equally. If our heirs, our beneficiaries are in different tax brackets, the bottom line is they may receive different amounts if it's a traditional or pre-tax IRA, because the rules state with a pre-tax or traditional IRA, when a non-spousal beneficiary inherits, according to the Secure Act, they most likely have to withdraw that money over a 10-year period. And if it's a traditional or pre-tax IRA that they're receiving, that means those distributions that they're having to take over that 10-year period are being added to their top of their income. And if you have some heirs that are in higher brackets than others, the bottom line is the net is different. But if it's Roth that's inherited, Roth is tax-free regardless of your heirs and their tax bracket. So Roth can be a great way to transfer wealth and not have to be concerned about any sort of disparity due to tax brackets of those beneficiaries. But what about a spouse? You know, let's think about our spouse. You know, if we pass away, our surviving spouse, our widow or our widow, they're only going to receive one of the Social Security benefits. They're not going to receive both. You know, for a married couple, that surviving spouse receives the higher of the two Social Security benefits. The smaller of the two Social Security benefits ends. So there's a reduction in income right there. Retirement accounts will generally combine into the name of the surviving spouse. Required minimum distributions, though, will generally continue even if the funds aren't needed. And I'll show you here in a second, but one of the biggest concerns, though, is a surviving spouse will probably eventually no longer be a married filing jointly when it comes to their tax bracket. So if they have to start filing as single, how is that going to affect them? Well, let's look at these tax rates right here. On the left, we've got single filer. On the right, we've got married filing jointly. Right down the middle of the triangle, we've got the different rates. But on the left side, we've got the income brackets for single, and on the right, we've got the income brackets for married filing joint. So let's just say, just to keep it easy and walk through this one example, what if a married couple has pension, Social Security, investment income, rental income, and they're at, just say, a $200,000 income per year? As a married filing joint taxable household at 200,000, they would fall in the 22% bracket. But at that same 200,000 level for a single filer, it's in the 32% bracket. Or what if we're in the 50,000 as a married filing joint couple? We're in the 12%, but at 50,000 for a single filer is in the 22%. So there's disparity there as far as income tax brackets, just depending on your filing status. So we have to take that in consideration as far as the net result for our spouse when something happens to us. And then we also have to take in consideration what's going to happen over the next couple of years. You've heard us talk about this. You're seeing a lot of headlines right now about the sunset of the Tax Cut and Jobs Act. At the end of 2025, the Tax Cut and Jobs Act sunsets and income tax brackets will change. You can see the discrepancy right here. 2025, we've got the 7 brackets we have right now, the 10, 12, 22, 24, 32, 35, and 37. In 2026, they changed to 10, 15, 25, 28, 33, 35, and almost 40. And the income ranges changed drastically as well. So what makes sense with Roth conversions based on what we know today at our income level? Does it make sense to go ahead and convert now prior to the sunset of the Tax Cut and Jobs Act? It may make sense for you. If you have questions, reach out to us, reach out to your tax preparer to see if it might make sense to convert from IRA or pre-tax traditional IRA to Roth based on where income tax brackets may end up after the sunset of the Tax Cut and Jobs Act. So what are some takeaways? One, think about that 5-year clock. If you're thinking about contributing to a Roth, do it sooner than later. If you qualify, open it up with a small amount just to start that 5-year clock. If you have old 401k funds, consider rolling them over, especially if they have Roth funds that you may want to access sooner than later. They're not treated the same. A Roth 401k right now is treated differently than a Roth IRA. Understand your beneficiary situation. Does it make sense for you to convert, pay tax at your level so that your heirs could potentially have tax-free Roth money? The Secure Act changed estate wealth transfer significantly with the rules that eliminated some of the access to lifetime distributions that are now whittled down to just a 10-year window. And then the Tax Cut and Jobs Act. It sunsets at the end of 2025. Brackets are set to change. Income ranges are set to change. Tax rates are set to change. Consider doing a Roth conversion if it makes sense to you, if it makes sense for your spouse, if it makes sense for your family. And remember, Roth conversions are calendar year based. They have to be done in the calendar year. They have to be completed by December 31st. And here at Steward Wealth Strategies, we're going to ask you to complete them and make the decision by Thanksgiving, because Roth conversions require paperwork. They require effort on your end. They require effort on our end. They require effort and work internally. And after Thanksgiving, there's a lot of days that are federal holidays. And, we have a very limited window at the end of the year. So please, while you're sitting around the Thanksgiving Day table saying what you're grateful for, I hope you're saying you're thankful for Roth IRAs, you're thankful for Roth conversions, and you pretty much have determined the amount that you want to convert. And we can get that done for you by the end of November. It's not what you earn, it's what you and your beneficiaries keep after taxes. We're all very patriotic here at Steward Wealth Strategies, but most of us probably don't want to send more money to Washington, D.C. than we need to. We probably want to limit how much of the IRS is part of our legacy. If we can help you with some strategic planning, if we can help you with your IRA to Roth conversion, if we can help you just decide if it makes sense right now, please reach out to us. Let us know. Our wealth management team would love the opportunity to talk to you between now and the end of November regarding a Roth conversion and whether or not it makes sense. Thank you so much for the opportunity to share this information with you. We're honored to serve you. If you're not a client of Steward Wealth Strategies, please use this information. Hopefully this can help you out. We all want to be good stewards, and our mission statement here at Steward Wealth Strategies is we want to help our clients get the most life and purpose from their wealth. Thank you very much. God bless you. It's an honor to serve you. Thank you.